VPOD.ai, your source for information. This podcast is sponsored by Stonefly, your trusted solution provider and advisor in enterprise storage, backup, disaster recovery, hyper-converged in VMware, Hyper-V, Proxmox cluster, AI servers, and public and private cloud. Check out stonefly.com or email your project requirements to sales@stonefly.com. Welcome back. Today we're tackling a term you hear thrown around a lot in finance and investing circles, EBITDA.
Yeah, EBITDA. It gets presented quite often as this cleaner way to look at a company's earnings potential, almost like a shortcut.
A shortcut, right. But it's also, well, pretty controversial, isn't it?
Extremely. I mean, you've got serious heavyweights raising red flags. Warren Buffett famously warned that, focusing too much on it might lead you down a dodgy path, potentially towards fraud.
And wasn't Charlie Munger even more blunt?
Oh, yeah. He just called it bull earnings. Straight up.
Okay, bull earnings. That's quite a statement. So what is this thing, EBITDA, that gets such strong reactions, both for and against?
Well, that's what we're going to dive into. We need to unpack the acronym, see how people use it, and really get into the weeds on why it's so debated.
Right. The goal here is for you listening to get a much better handle on what EBITDA actually tells you, and maybe more importantly, what it doesn't tell you, when it's useful, when it's, well, potentially dangerous.
Exactly. So first off, EBITDA. It stands for earnings before interest, taxes, depreciation, and amortization.
Okay, earnings before interest, taxes, depreciation, amortization. So the calculation itself involves adding those things back to the earnings.
Precisely. You start with a company's reported earnings, usually net income, and then you add back the interest expense, the income taxes paid, and these two non-cash charges, depreciation and amortization.
So what's the effect of doing that? What picture does it start to paint?
Well, by adding back interest, you're basically ignoring how much debt the company has and what it costs to service that debt. Add back taxes, you're ignoring government levies, and then depreciation and amortization. These account for the wear and tear on physical assets, like machines, and the declining value of intangible things, like patents. Adding those back ignores the cost of maintaining and replacing assets over time.
So it kind of strips away some very real-world costs and obligations. Can you give us, like, a simple example?
Sure. Think about, say, a small store owner. Maybe they took out a big loan, a mortgage, to buy their building, and they've got equipment, shelving, that kind of stuff that wears out.
Right. Standard costs of doing business.
Exactly. Now, under normal accounting, that mortgage interest payment and the depreciation on the building and equipment, those reduce the reported profit.
Makes sense.
But if that owner just focused on EBITDA, they'd add back the interest payment, add back the depreciation. Suddenly, the business might look, on paper, way more profitable.
Even if cash is tight because they still have to actually make that mortgage payment.
Precisely. It can create this illusion like they're rolling in dough, when in reality, the actual cash flow might be much lower because those expenses are real cash outflows or represent real asset decline.
Okay, that really clarifies how it can skew things.
Yeah.
But clearly, some people find it useful. What are the arguments for using EBITDA? Why do they champion it?
Well, one big argument is that it's seen as a quick proxy for operating cash flow. The idea is strip out the financing decisions, interest, the tax structure, and the non-cash accounting charges, D&A, and you get a cleaner look at the cash being generated just from the core business operations.
Like, how good are they at actually selling their coffee or widgets, regardless of their debt or building ownership?
Kind of, yeah. It's about isolating that core operational performance.
Okay. What else?
Another key point, especially in M&A or comparing companies, is neutralizing differences in capital structure and taxes.
Oh, so?
Well, one company might have lots of debt and high interest payments. Another might have none. One might be in a high tax area, another in a low tax one. By removing interest and taxes via EBITDA, the argument goes you can compare their underlying operational efficiency more easily.
I see. So if you're thinking of buying a company and maybe refinancing its debt anyway, you look at EBITDA to see the engine before you tinker with the financing.
That's the rationale, yes. It's about assessing the basic profitability of the business model itself, separate from, the financial engineering or tax jurisdiction.
Okay, so there are reasons. But then we come back to Buffett and Munger and the serious criticisms. What's the core of the pushback?
It really boils down to this. Interest, taxes, depreciation, and amortization are real. They aren't just a accounting fluff.
Right. Companies actually have to pay interest. They actually have to pay taxes.
And their assets actually wear out. Depreciation might be a non-cash charge in one accounting period, but eventually you absolutely have to spend real cash to replace that worn-out machine or update that building. Ignoring these gives you an incomplete and potentially very misleading picture.
It goes back to that store owner ignoring the mortgage payment, right?
Yeah,
You can't actually do that in the real world.
exactly. That rolling in dough illusion is the danger. It can mask serious underlying problems. A company could have great-looking EBITDA, be drowning in debt payments it can barely afford.
And this creates an opportunity for, let's say, selective presentation by management.
That's a huge concern. Management might push EBITDA figures in press releases because they look better than the standard GAAP net income. They might call it adjusted earnings and hope investors don't look too closely at what got adjusted out.
Which could range from understandable adjustments to, well, getting into Munger's territory.
Potentially. You see extreme examples sometimes, like ARK Invest was highlighted for treating R&D and marketing almost like capital investments and ignoring certain costs. While not strictly EBITDA, it's part of that broader trend of adjusted figures that can stray really far from standard accounting realities.
So the big worry is that EBITDA hides the true cost of staying in business and the burden of debt.
Absolutely, especially the debt part. Think about it. EBITDA makes a company loaded with debt look potentially just as good operationally as one with zero debt because the interest cost is just added back.
That seems fundamentally risky. It ignores a massive difference in financial health.
It does. You could have a company showing positive EBIT but actually burning through cash once you factor in capital expenditures and debt service. That's not sustainable.
Okay, so given all these significant downsides, are there contexts where EBITDA is considered a more acceptable, maybe even necessary tool?
Yes, it does have specific uses. Lenders, for example. Banks often look at EBITDA.
Why banks?
Because they want to know if the company's operations are generating enough earnings to cover the interest payments on the loans they've provided. Since EBITDA is before interest, it gives them a quick check on that debt service capacity.
Okay, that makes sense from their perspective. What about buying and selling companies? You mentioned M&A earlier.
Right. In private equity and M&A, it's very commonly used as a starting point for valuation. They use it to get a baseline sense of the target's operating profitability before they factor in their own plans for, say, changing the debt structure or finding cost savings.
But it's just a starting point, presumably, not the final word.
Oh, absolutely not. It's one metric among many in a deep due diligence process. No serious buyer relies solely on EBITDA.
We've spent a lot of time on what EBITDA misses. Are there other metrics investors should look at that maybe capture some of those missing pieces?
Definitely. A really important one is free cash flow, or FCF.
Free cash flow, how does that differ?
There are different ways to calculate it, but a common one starts conceptually near EBITDA, but then subtracts capital expenditures, the actual cash spent on maintaining and upgrading assets like property, plant, and equipment.
So it brings back in the reality of reinvesting in the business.
Exactly. FCF gives you a much better idea of the actual cash the company generates that's truly available to pay debt, pay dividends, or reinvest after accounting for the money needed just to keep the physical assets running. It's much more grounded in cash reality.
So it sounds like the overwhelming message here is context is everything, and don't look at EBITDA in a vacuum.
That's absolutely the key takeaway. It's one data point. It can offer a perspective, particularly on operational trends if used carefully over time, but you have to look at the full financial statements, the income statement, the balance sheet, the cash flow statement.
Understand the debt levels, understand the capital expenditures.
Understand the industry, understand a specific company. You need the whole picture. Relying on just EBITDA or any single adjusted number someone puts in a headline is frankly just asking for trouble. You need to understand what assumptions are baked in.
VPOD.ai, your source for information. This podcast is sponsored by Stonefly, your trusted solution provider and advisor in enterprise storage, backup, disaster recovery, hyper-converged and VMware, Hyper-V, Proxmox cluster, AI servers, and public and private cloud. Check out stonefly.com or email your project requirements to sales@stonefly.com. So wrapping this up, it seems EBITDA provides this simplified view, focusing on operations by stripping out certain costs, but that simplification comes at a potentially high price.
Yeah, the price is ignoring very real financial obligations and costs debt, taxes, asset replacement, things that absolutely impact a company's long-term health and value.
The convenience versus the potential to be misled.
That's the tension right there.
Which leaves us with a final thought for you, our listener. Knowing the debate, knowing the potential pitfalls that even investing legends warn about, how do you personally strike that balance? How do you use a potentially convenient metric like EBITDA without letting it obscure the full and often more complex financial truth of a company? Something to mull over next time you see that figure highlighted.
Definitely worth thinking about. Look deeper. Always look deeper.
VPOD.ai, your source for information. This podcast is sponsored by Stonefly, your trusted solution provider and advisor in enterprise storage, backup, disaster recovery, hyperconverged in VMware, Hyper-V, Proxmox cluster, AI servers, and public and private cloud. Check out stonefly.com or email your project requirements to sales@stonefly.com.